Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 99, we're going to look at the life insurance transfer for value rule. We've looked at life insurance in great detail in the past with respect to gift and estate tax planning and dug a little bit into Goodwin situations, and now we're going to look at a theme that's kind of boiled in the background, and that's the transfer for value rule, which is really an income tax only rule, as we're going to see. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, generally, life insurance proceeds are not subject to income tax when received by the beneficiary of the life insurance policy. There's a policy reason for that because the IRS doesn't want to tax like a widow or a dependent or anybody on life insurance that's designed to supplement or replace the lost income of a deceased insured. However, sometimes policies can be sold between certain parties, and in the case of such a sale, that policy reason for not taxing the proceeds disappears because the policy moves from being being a supplement to being more of an investment in the case of such a sale or exchange of a life insurance policy. So, when the transfer for value rule applies, is where there's a sale of a policy or an exchange of the policy, where there's any valuable consideration changing hands in exchange for the change of ownership of the policy itself. Now, the result is that all of the death benefit of the policy will become subject to income tax, but like with any investment, the owner or the beneficiary here can subtract the policy purchase price plus the aggregate premiums paid post-purchase by that beneficiary owner. Now, it's important to note that this rule doesn't apply to gifts of policies, only to exchanges. So in past episodes, we've explored how the gift tax and estate tax can apply to life insurance policies if they're owned by the insured at death or transferred by the insured within 3 years of death, and there's a gift tax cost to any non-sale transfer of a policy, typically equal to the unearned premium on the policy for the year of transfer, plus the PS51 value, which would be the cash value plus the insurance company reserve generally. Now, this transfer for value rule isn't a hard and fast rule. There are some exceptions which are important to know, which we'll cover here. And when these exceptions apply, then even though there's a sale or exchange of the policy, the death benefit will not become subject to income tax. First exception is pretty easy. Anytime the insured purchases ownership of the policy into their own name, that's not a transfer for value. So any transfer to the insured will never be a transfer for value, regardless of what the insured gives in exchange for receiving ownership of the policy back, because it's just returning the ownership of the policy to a more natural state where it's designed to move from investment to more of a supplement. Now, this comes into play with trust planning because sales to a trust can be used to avoid the 3-year rule and the estate tax issue I noted with gifts of policies, but the trust should be a grantor trust in order to take advantage of this exception, because with a grantor trust, the trust is disregarded and the trust's purchase of the policy in such a case would be treated as a sale to the insured as the grantor. Non-grantor trusts generally are not exempt from any of the transfer for value rules. So, with revocable trusts and a lot of irrevocable trusts, they'll generally be grantor trusts so long as the income of the trust can be used to pay premiums on the life insurance that insures the life of the grantor or the grantor's spouse. Now, the second exception, we're going to look at two now that really apply more in a business context. The first is transfers within partnerships. So if the insured is a partner in a partnership, then a lot of the transfers in and among the partnership ownership group would not be subject to the transfer for value rule. And this could include not only a sale, but maybe a transfer of a policy in exchange for a partnership interest, which would be an exchange usually. So some examples would be any transfer between the insured and the partnership, and any transfer between the insured and the other partners. You could also have any transfers between any partner and partnership and transfers between the partners themselves, so long as the insured is a partner in the partnership at the time of the transfer. Now, when I use the term partnership here, I'm not referring to an entity that's organized as a partnership. I'm referring to any entity that is treated as a partnership for federal income tax purposes. So, for all intents and purposes, this could include any state law partnership, whether it's a general partnership, a LP, a double LP, a triple LP, whatever the case might be. This could also include a limited liability company, an LLC. So this isn't entity specific, it's more tax status specific when you look at a partnership itself. So this exception can be very helpful in buy-sell agreement planning because it allows for the free movement of policies among the partnership and the partners in order to fund buy-sell obligations that might be triggered by the death of a partner or an LLC member. Now, the third exception applies to transfers in corporations. Now, this really applies first if the insured is a shareholder or officer in a C corporation or S corporation, and in that case, the following transfers would not be subject to the transfer for value rule. One would be a transfer from the insured to the corporation, and the other would be a transfer from the corporation to the insured. And then finally, any transfer from a shareholder to the corporation would also be accepted from the transfer for value rule, so long as at the time of the transfer, the insured is also a shareholder or officer in the corporation. Now, it's important to note that this is more restricted than the partnership exceptions because we don't have the same flexibility of transfers among the ownership group. So, for example, transfers from corporation to a shareholder other than the insured would still be taxable, and transfers between shareholders other than a transfer to the insured would still be taxable as well. So this also gives that flexibility to be used with buy-sell agreement planning, but there's more pitfalls within the corporation, not only for the transfer for value rule, but also how the policy and its death benefit would be treated at the corporate level as well. Now, finally, even if any of these exceptions applies, you have to look at the exception killer, which is reportable policy sales. This is a more recent addition to the Internal Revenue Code and the regs, but if there is a reportable policy sale, then even if an exception exists, the death benefit of the policy would still be subject to income tax minus aggregate premiums and purchase price paid by the beneficiary. So when does this apply? It applies in any situation where the acquirer acquires a life insurance policy directly or indirectly. Indirect could be like through an entity, like purchasing an interest in an entity or something. And really where this applies is where the acquirer has no substantial family, business, or financial relationship with the insured other than the policy itself. Now, it's pretty easy to meet these exceptions, but it's still the case where if somebody wanted to try to get around the transfer for value rule, they could just try to set up a partnership with an insured, and in such a case, they couldn't use an entity to circumvent these rules, and that's really what this reportable policy sales exception to the exception is designed to circumvent. So before you do any sort of tax planning, it's important to dig into the facts and circumstances to make sure that this exception killer does not exist. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.